Everybody tells you to leave your retirement money alone until you're 59 and a half. If you're planning to retire early, that's some of the most expensive advice you'll ever follow. This is part 4 of the retirement tax map. We've covered tax buckets and brackets. Now we build the actual machine that the standard advice ignores, a conversion ladder that turns locked-up retirement money into spendable cash early and ideally tax-free, because the conventional wisdom assumes you'll work until your 60s and only then start spending. Retire at 55 with a fat 401k and you smack straight into a wall, told you can't touch your own money for years without a penalty. The standard answer is to just wait. The better answer is to climb over the wall. Here's why waiting is the wrong move. Your traditional 401k and IRA are stuffed with money the government hasn't taxed yet. Pull it before 59 and a half the normal way, and you eat a 10% penalty on top of regular tax. So early retirees don't pull it the normal way. They use a rule hiding in plain sight, Roth conversions, stacked year after year like rungs on a ladder. A Roth conversion just means moving money from your traditional account into a Roth account. You pay ordinary income tax on whatever you convert that year, but once it's converted, a special clock starts. Each converted amount becomes penalty-free to withdraw after just 5 years, not 59 and a half. 5 years. Convert today, and 5 years from now, that exact dollar is free to spend. Picture planting seeds. Every year you convert a chunk and plant it. 5 years later, that year's harvest is ready to eat, penalty-free. Keep planting yearly, and you get a steady harvest every single year after that. The latter is just overlapping 5-year clocks. Convert in year 1, spend it in year 6. Convert in year 2, spend it in year 7. Stagger them and you create an unbroken stream of penalty-free income. Now, the obvious objection, and it's a good one. What do you live on during those first 5 years before the first rung ripens? You bridge the gap with cash savings, taxable brokerage money, or Roth contributions you can already pull tax-free. That bridge is the part most people forget, so we'll build it into the plan in a minute. And this is where the contrarian move really pays off. In early retirement, your income often drops to almost nothing. No paycheck, no W-2. That means you've got empty space in your lowest tax brackets just begging to be filled. Every year you've got a standard deduction, around $15,000 for a single filer as of 2025. Income up to that amount is taxed at 0. So you can convert that much each year and owe literally nothing. Want to move more? Fill the 10 and 12% brackets too. You're voluntarily paying a tiny rate now in your low-income years to dodge a much bigger rate later when required distributions hit hard. Contrast that with following the usual advice. Leave everything in the traditional account, watch it grow, then get forced to withdraw it later at much higher rates, possibly dragging your Social Security and Medicare costs up with it. Let's make it concrete. $600,000 in a traditional IRA and you retire at 50. Convert about $30,000 a year, mostly in the 0 and 10% zones. Over time, you've moved hundreds of thousands into your Roth, paying only a sliver of tax along the way. The FIRE community, the early retirement crowd, has run this exact playbook for over a decade to fund their freedom. Once that money lives in the Roth, it grows tax-free forever, comes out tax-free, and has no required minimum distributions ever. You've turned a future tax bomb into a permanent tax shelter. So let's build it. First, build your bridge. Before you convert a dime, make sure you've got roughly 5 years of living expenses outside your traditional accounts to live on. Second, calculate your conversion headroom each year. Look at how much room sits inside your target tax bracket after your other income. That number is roughly how much you can safely convert without jumping into a painful rate. Third, convert that amount before December 31st. Conversions count for the calendar year you do them, so don't wait until the last week and risk a processing delay. Set a yearly reminder and treat it like a ritual. Fourth, pay the tax from outside money if you can. Using your cash to cover the small tax bill instead of the converted funds means every converted dollar gets to grow inside the Roth. Maximize the seed. And fifth, repeat every year and track each rung. Keep a simple spreadsheet listing the year you converted and the year it becomes free. That record protects you and proves each conversion has cleared its 5-year wait. Now dodge a few traps. Watch the pro rata rule. If you've got pre-tax and after-tax money mixed in your IRAs, conversions get taxed proportionally. It's not a deal breaker, but it can surprise you. Next, don't convert so much that you spike into a high bracket or trigger health insurance subsidy cliffs. If you buy marketplace coverage, a big conversion can shrink your subsidy, so weigh the tax savings against the credit you'd lose. And remember, each conversion has its own separate 5-year clock. The dollars you converted in year 3 aren't free until year 8, even if your year 1 batch already ripened. Track them individually so you never pull too early. One quiet bonus: these conversions also shrink your future required minimum distributions. Less stuck in the traditional account at 73 means smaller forced withdrawals and lower taxes in your later years. You don't need to be a CPA or a millionaire to do this. The latter is just patience plus a calendar. Anyone with a traditional account and a few low-income years can build it. If it still feels intimidating, start with one conversion this year, even a tiny one, just to learn the mechanics. The first rung is always the scariest. After that, it's pure repetition. This is the engine behind so many of the early retirements you read about online. It's not flashy, and it's not a hot stock tip. It's smart tax timing, done patiently, while everyone else quietly overpays. Pull up your accounts this week and check how much sits in traditional versus Roth. Then mark a date, maybe each November, to review your headroom and execute. Boring, repeatable, and quietly life-changing over a couple of decades. One honest caution: these numbers are examples and 2025 figures, and tax rules shift. A conversion is permanent, so for big moves, run it by a tax pro. In the next part, we'll cover how to sequence your withdrawals across all your accounts. The penalty wall isn't a dead end. It's just a wall, and now you've got the ladder. So tell me down in the comments, which piece hit you hardest today? The penalty wall, the 5-year clock, or the subsidy cliff? Be honest, your answer helps me sharpen the next lesson. If this made early retirement money finally make sense, give it a like so it helps the channel, send it to one person you know who's planning to retire early, and subscribe so you catch the withdrawal sequencing video next.